Hello and welcome to CIO Perspectives. I'm Sid All, the co-CIO of Private Client Endowments and Foundations here at Brown Advisory, and I'm joined by my co-host and co-CIO, Erika Pagel. Today, we'll be welcoming back Erika Gordon, a portfolio manager here at Brown Advisory and a stock picking expert. We're going to talk a little bit about what's driving markets, what we've been hearing from companies this earnings season, but also about some increasingly dominant themes that we're tracking. These include the increasing need for power due to the emergence of AI, the growth and shifting competitive dynamics in aerospace and defense, and some recent advancements in life sciences. But first, maybe, Erika, let's get our obligatory inflation discussion out of the way, since these numbers have been really big drivers of markets for some time now. Inflation has remained a bit sticky, and we've had some mixed news on this front of late. Can you give us a high-level update on how things are looking for inflation and the Fed?
Well, hard to believe, but we're nearly halfway through 2024, and it's a bit of the same since our last conversation. We're still talking about inflation, we're still talking about the Fed, and it's still a mixed market environment. We've got a bull equity market, mostly driven by a few stocks and sectors, and we have a bear treasury market with yields moving higher. So to start, the economy remains resilient despite many headwinds. GDP growth has exceeded expectations. The labor market remains tight, but there are signs of weakness, and the consumer is spending, but the consumer is getting pickier and is much more focused on price and value. So to focus on the Fed for a minute, market expectations for inflation and rate cuts got ahead of themselves at the end of last year. This really happened after the Fed delivered a more dovish tone, and the market interpreted this message that we're finally at peak rates and that cuts would be the next step, and the next step would happen very quickly. At that point, the market priced in an implied market rate of about 3.7%, and that was versus the target rate at 5.25 to 5.5%. So a substantial number of cuts that were priced in as we came into the year. The markets, over the past couple of days and week are pulling back as the reality sets in that there may be one, there may be two, or there may not be any rate cuts this year. So look, the Fed's 2% inflation target was never going to be easy. The rate of disinflation has slowed, and we've entered this period of L-shaped inflation. April inflation was better than consensus expectations. We saw more modest month-over-month increases. But, as you mentioned, there's stickier areas. There's elevated areas in housing and rent, but we have areas like medical costs and insurance that are also remaining high. Core CPI, it's still above the Fed's 2% long-term target. And look, the Fed looks at a lot of other metrics, PCE, which is the Personal Consumption Expenditures Index, that's been running slightly lower than CPI. And Fed Chair Jerome Powell characterized the most recent PPI data, which is essentially inflation on manufacturing, as quite mixed. So we're still in this environment of mixed data. And as a result, we have a very patient Fed, but as usual, we have a very impatient market. And Jerome Powell's language and preferred data points have also evolved. So go back to 2022, the message was better balance. And today it's all about incoming data. So we think that there's still reason to believe that inflation will continue to come down, but the market today is fixated on when the first rate cut will be. As we inch closer to the second half, and I know Eric will talk about this, there's high expectations. There's high expectations for earnings growth. There's high expectations for rate cuts, although that is starting to normalize. So we're very back half loaded this year. So today there's higher probability that we are in an environment that's higher for longer as inflation pressures persist. Incremental data points are winning and they're moving the market. And there continues to be this tug of war between higher rates, higher inflation, and earnings growth.
Programming note here, Jerome Powell's preferred measure of inflation, core PCE, is actually going to come out tomorrow. We're recording on May 30th here. We'll get the next big data point the market will surely become obsessed with. Maybe, Eric, what do you think as an equity investor? Does the Fed need to cut rates for the markets to move higher from here?
Thanks, Sid, and it's a pleasure to join you and Erika today. I'm not one to predict market directionality. However, it does seem reasonable to assume that the Fed rate cuts would correlate with a broadening of market leadership. So we're looking at the Fed actions through that lens. It's remarkable to consider that year-to-date, fewer than 1/3 of S&P 500 constituents have beaten the index, while only about a quarter of Russell 1000 growth constituents have beaten that index. So it's just been remarkably concentrated in terms of leadership. We've seen an extremely narrow thematic approach to public investing this year in equities. 20 of the top 25 performers in the S&P 500 are associated with one of two themes, either generative AI and the related data center build out, or aerospace and defense. And we'll talk about both of them during this conversation. And it makes sense, directionally at least, given what we've been hearing from companies during earnings season. At the same time, there are a lot of areas of the market that should have significant upside against a broader, more optimistic economic backdrop if you have a multi-year time horizon. That isn't to say that the current winning themes can't continue to see absolute appreciation. It's just that typically lower rates are eventually supportive of broader economic growth as the cycle progresses, a consideration that today market participants seemingly aren't willing to invest in.
Thanks, Eric. Maybe, Sid, turning back to you, what's your take on everything that's going on, what Eric just mentioned, and how are you interpreting all the data today?
I think you hit a lot of the mixed view here, which is I think everyone's been surprised at the strength of the economy. The strength of the economy has been powering inflation or keeping it from coming down as fast as the Fed would have liked. I do think there are some positive signs. We've seen commodity prices coming down. We've seen a little bit of recent softness in rents. Wage growth the last 3 months has been below inflation. And Eric, you shared the news with us recently from Target that they're cutting prices on 5,000 everyday items. You haven't seen an announcement like that in a long while. We've also heard a lot lately about the so-called vibe session, the feeling that Americans have that the economy isn't quite as strong as the numbers suggest. So the economy has been really strong. And as it softens a bit, that could filter through to lower inflation. The last thing that I think about is China is in some ways exporting deflation to the world right now with low prices on lots of goods. It was interesting to see Biden's new tariffs on Chinese goods like EVs and solar components. That won't help inflation, but it's a response to China sending out cheaper goods, which is deflationary. What I found really fascinating is that the strength of the economy and the stickiness of inflation has surprised investors so much that this month you had the fixed income CIO of BlackRock come out and say we need to cut rates to bring down inflation, which is a bit of a head scratcher. I think the argument goes in that camp that cash yields are so high now, higher than most mortgage rates and some legacy corporate borrowings, that perhaps these yields are stimulating consumption. I'm not sure I'd go that far. I think the impact of higher rates has definitely been delayed by those low-cost borrowings that need to be refinanced at some point. But it shows you just how confused Wall Street has been by what's going on. I think I'm still of the view that inflation will drift down to this 2 to 3% range and that the Fed will cut later this year, and that buying core bonds when the 10-year is close to 5% makes sense with that kind of inflation expectation. So, I've added a bit to bonds and duration when we've approached these levels. Maybe, Eric, what are companies telling us about the state of the economy, knowing it's very different industry to industry, as you outlined already?
Well, Sid, I think that the focus here should probably be on the consumer, since that is driving the bulk of the economy today. And we've had dozens of companies in the consumer arena report results just over the last couple of weeks. And I would say that the most significant takeaway from earnings has been that while the higher income consumer, and let's just call that maybe $150,000 or $200,000 in annual income and above, continues to spend in a healthy way, the middle and lower income cohorts are starting to face pressure from both inflation and elevated interest rates. So some of the more recent data points, Sid, you mentioned with Target lowering prices on a multitude of products, but generally speaking, we've heard from Lowe's, AutoZone, and other retailers that large discretionary purchases, and really anything above $500 or $1,000, are getting deferred. Aspirational consumers are passing on that afternoon Starbucks coffee treat, and many others are exhibiting trade down behavior, supporting value priced retailers such as Walmart, Dollar General, and off price retailer TJ Maxx. Thus, while at the headline level, the consumer remains resilient, and we've heard that phrase so many times over the course of the last several months, in addition, travel remains stable. It seems as though travel for both corporate and for leisure purposes remains strong around the world. Let's not forget that 1 in 3 Americans are currently maxed out on at least one credit card, and that data point came from the Target earnings call. So it's no surprise to me, at least, that only 2 of the top 25 performers in the S&P 500 this year are in the consumer sector.
It's a pretty imbalanced, strong economy right now. And I was thinking about, we've had these periods, 2015, 2016, we had the industrial recession. We've had periods of profit recessions. It feels like we have a very strong economy right now, but a lot of that is tied to the areas in the market that you talked about are performing well. So in tech and everything to do with the AI build out. And then in places like aerospace and defense, which have benefited from a return to travel, and then the unfortunate conflicts that we've seen around the world. Maybe, Erika, what are you seeing in terms of the state of the consumer?
Yeah, and Eric covered a lot of this, but the story over the past year is that the consumer is spending, and there's a few areas that we think are really have been driving this. So first, real wage growth. So as long as wages were above inflation, the consumer is going to spend out of their wallets. Second is the psychology of inflated wallets from rising property values, from rising investment values. We've cautioned that these assets tend to be harder to monetize. So there has always been this greater likelihood of taking on increased leverage and producing higher delinquencies as a result of that psychology of those higher values. And then third, this is much more tangible. Sid, you talked about this, but interest income from money markets, from cash, from bonds are much higher. You talked a little bit about cash is now above mortgage rates, but that's after years of zero benefit. So where are we today? We're seeing weakness in the labor market. Sid, you mentioned real wage growth declines. In some regions, wages are now below inflation. So look, the consumer is a fragile engine. Higher inflation and higher rates for longer can very quickly change consumer habits, and we're starting to see some of those breaks. Another area is oil prices are now back up at 85, and that tends to be a negative to consumer perception as well as spending. But the data continues to be mixed. We just got a consumer confidence number that improved in May after 3 months of decline. Retail sales in April were lower, but that could be payback from very strong February and March numbers. But as far as we can tell, consumer headwinds appear to be mounting, and it's this story of the haves and the have-nots. There's a split spending that's taking place. So lower income households tend to be more disproportionately impacted by higher inflation. But, we're now seeing more price-aware spending in middle incomes, particularly as that wage growth momentum slows. So goods have experienced deflation. You mentioned shelter remains sticky, but those wage-sensitive areas like services outside of housing is still inflated. And there's a Harris poll out there recently that 56% of Americans believe that we're in a recession. Wow, that's pretty startling. And as Eric mentioned, several retailers have pointed out weakness in discretionary areas and lower end. Not only Target, but you've heard it from Walmart, PepsiCo, McDonald's, Starbucks. They're all reporting that price sensitivity. Another area that we talked about in our market outlook is buy now, pay later. This is now popping up in categories such as groceries. So people are using buy now, pay later to buy their food. And the estimates out there are that this kind of phantom debt is in the billions. Eric touched on this, but credit card interest payments and delinquencies are rising. A recent New York Fed consumer credit survey showed that younger, lower income credit card users are more likely to be maxed out. And keep in mind, credit card interest rates are above 20% right now. So the longer rates and inflation stay higher, the likelihood that more consumers, not only low income, will curb their spending.
Yeah, that 57% who feel like we're in the recession, that's the vibe session. That is the feeling that people have. But also, it seems very different in different states and different counties based on where wages and inflation are there, and then very different by income cohort. So, I mean, I think you pointed a lot of this out. Maybe let's shift to talking about AI, which seems to be what is the only thing anybody wants to talk about in markets these days. Eric, we've had some continued advancements. I mean, they're coming at very rapid pace. Saw the release of Vertex AI from Google. We've had Meta's open sourced AI model, Llama. We had OpenAI release GPT 4.0 and the Scarlett Johansson drama there. We've had Elon Musk out raising money to jump into the AI model design game. I mean, first, I would say it is pretty cool to see these AI models that incorporate speech, video, and text. It feels like we're getting closer to this AI assistant that everyone seems so excited about. But I've been surprised to see how intensely competitive this environment is and how costs are falling so quickly. And companies like Meta are open sourcing their product. How have these rapid fire advancements impacted our views on the big tech companies? Who could be the winners, losers, and how do you see profits shaking out?
It's a huge question, Sid. And so I'm going to take some time just to frame out how we're thinking about it by taking a step back, perhaps first. I think we need to recognize that we're still in the very early innings of the generative AI economy. And so drawing conclusions on distinct long-term winners remains really, really difficult, perhaps outside of NVIDIA. But investors are very quickly willing to vote on who will win and who will lose based on anecdotal information. So just a couple of examples here. Alphabet was vilified 15 months ago for a failed demonstration of its large language model, with many investors seemingly ready to declare the end of its search dominance. The stock has since doubled. A few weeks ago, Elon Musk, you mentioned Elon, he stated that Tesla would present an effective robotaxi of the future this upcoming August 8th. And he's promised this many times before. He's kind of the boy who cried robotaxi at this point, in my opinion. Yet by touting vast improvements to Tesla's full self-driving offering based on generative AI training success, Tesla's stock has jumped 25% over the past month. Most recently, enterprise software stocks are being penalized over concerns that seat growth will be permanently impaired due to productivity and efficiency gains associated with Gen AI use cases. As Sid mentioned, we're recording this on May 30th, and Salesforce reported results last night, and the stock is down 20% as just one example of where the software area has seen just tremendous weakness based on either slight misses or reductions to guidance just by a little bit, perhaps in part due to the macro, but also in part due to these concerns that I just referenced. Today, many companies are brainstorming to determine use cases for the large language models, while concurrently putting as much of their structured and unstructured data into these models for training purposes. This effort will likely be followed by an iterative process of developing stronger, lower latency models for use and inference, as well as more targeted use cases among businesses and individuals. And eventually, the return on investment of these models, and more basically the chips and software that generate the models, will be measured more precisely, in our opinion, which will help determine the ongoing rate of growth for the Gen AI economy. But as a society, in truth, we're nowhere near being able to answer that question yet. I think additional unknowns include eventual regulatory considerations that are impossible to predict. The reality is that very few software companies have solved the riddle of how to monetize generative AI at this point. So Microsoft, with its various Copilot offerings, has a Gen AI-based assistant across most of its businesses today. And within Azure, its cloud business, Microsoft's revenue growth benefited by 7% in the most recent quarter, specifically from the monetization of a combination of these offerings, including GitHub Copilot, which helps you write code faster and with less effort, as well as large language model inferencing for third-party applications. So that's 7% growth on one of its businesses. It's impressive, but it pales by comparison to what we've seen from NVIDIA and other semiconductor companies.
Yeah, it's easy to forget that this revolution really started in the fourth quarter of 2022. So it's been about 18 months, and the developments are coming fast and furious, and it is really competitive. I mean, I think it's been really interesting to see that Meta's AI model for some developers was considered on par with OpenAI's for a while. And there's Perplexity and Anthropic and others that are very well funded and designing models that many view as competitive. And it's not clear what the revenue model will be if Meta's open sourcing their model and prices are falling really quickly. So for the people designing the models, who will be the winner and what kind of rent they will be able to charge for that is not certain. And then, as you say, for the software businesses, if all of them end up incorporating this, how much extra will they be able to charge for that is still very much up for debate. So are we seeing any slowdown in the chips demand related to AI, Eric?
That's going to be the easiest question I get to answer today. In 3 words, not at all. 12 months ago, NVIDIA reported quarterly data center revenue of about $4 billion. In the most recent quarter, that figure ballooned to nearly $23 billion. So it was up 427% in a year. Again, let's compare that to Microsoft's Azure, which grew by 31% year over year. Only 7% of that growth came from AI. So just incredible transformational growth coming from a very large company like NVIDIA. On its earnings call, NVIDIA put to bed any concerns regarding demand growth over at least the next 12 to 18 months for its chips and systems. The types of buyers are becoming more diverse as well. So not only the cloud service providers, consumer internet, and enterprise software companies, but now we're seeing sovereigns investing heavily in NVIDIA's products. Auto companies, we've heard Elon Musk talk at length about purchasing GPUs, and healthcare companies as well are joining the party. Jensen Huang, who's NVIDIA's CEO, he commented that the company remains supply constrained for chip production with demand well ahead of supply in an environment likely to last well into 2025. I should also note that NVIDIA continues to deliver next generation GPUs that will be much more energy efficient and much faster computationally than prior versions. So outside of aerospace and defense, the investment theme centered around this acceleration in Gen AI consumption growth is the only show in town. And it doesn't only relate to the semiconductor group, but also companies that are involved in the build out of data centers, which we'll get into in a short while.
Sid, there's clearly lots of excitement around AI and particularly AI in the private markets. What are you seeing in terms of activity? I was having a conversation the other day about the differences of public versus private market investments, just with AI moving so fast and being able to capture those opportunities.
Really interestingly, despite the expectations that valuations would reset in VC, we really haven't seen that happen yet in the headline numbers. And most of that is due to AI because these deals are happening at high valuations and they are representing a large percentage of a smaller number of deals that are getting done. So we're basically at peak VC valuations right now because AI is in its own stratosphere. And part of that is because the market opportunity is so large. It's also because these will be more capital intensive businesses to develop these technologies, given the cost of that AI infrastructure, which Eric just talked about, which is kind of in backlog. These companies need more money. Right now, a third of all venture dollars are going into AI. And a big chunk of that is actually coming from the big tech companies who are funding their chosen AI models like OpenAI and Anthropic and Perplexity. And 90% of the AI dollars are going into either horizontal AI models, like the ones I just mentioned, or vertical applications in areas like coding assistance, kind of like what Microsoft's doing with GitHub Copilot, but also finance and consumer applications. Still much, much smaller dollars are going into areas like chip design and automated machines and robotics. As to what our managers are telling us, I think we're hearing mixed views. I think some of them are expecting that 50%, 75% plus of their funds might be dedicated to AI. And then we hear from some others that they view the landscape as still so new, so uncertain, and so hot right now that they're wary putting money to work. But I would say very importantly, unlike with crypto, which was the last obsession of the VC universe, I think all of our VCs would agree that the opportunity around AI is enormous. It's real. And there are opportunities to build businesses that both the big tech companies may want to buy, may want to use, or they could be standalone businesses of real scale. Maybe, Erika, back to you. I mean, given all this AI growth, we've been doing a lot of work recently on investments in data center developments within our private team. The most notable risk that our team has identified is actually just getting power to the sites. For 20 years, power consumption showed no growth as the world was focused more on efficiency, but it's growing now. And partly this is because AI searches require 10 times more energy than a simple Google search. So data centers, which are 1% to 2% of power demand, are growing quickly in that demand. How is this impacting the investment landscape? And are we going to have enough power to power this AI boom?
Well, we may be witnessing a very unlikely relationship or marriage of technology and energy. So AI, crypto, Google searches, streaming videos. We're living in a power-hungry society, and we need more energy supply to support this demand. Bigger models require more chips, more costs, more energy, and the demand for electricity is growing at a time when decarbonization is also in focus. And there's so many more components that are reliant on the grid today. So think about solar, EV charging stations. You mentioned crypto, so mining crypto. And there needs to be a balance. We've got to support the growth that we're seeing today and have the electricity for that. But we also don't want to aggravate water supplies, create more fossil fuels, stress the power grid, or reverse any environmental priorities. So for one, it's really hard to get accurate data. And Eric touched on this a bit, but there's an absence of regulation. So utilities right now, they're starting to prepare for double the load. Alphabet has said an AI chat box search can cost 10 times more than a traditional Google search. And I'm sure you've all seen the claims out there that computational power that's needed to sustain AI's growth is doubling every 100 days, or training a single model uses more electricity than 100 US homes consume in a year. So when will there not be enough electricity to run all chips? Elon Musk has said that supply will be hit soon and possibly next year. So for reference, if we look back the past 15 to 20 years, US electricity demand in the US has essentially been flat. And it's expected to grow by 3% from 2023 to this year. But the US has aging power grids. Many have an average age that's more than 40 years. AI could reshape the energy industry, especially infrastructure. And historically, innovators that are disruptors can speed up new technologies that have had a harder time scaling. And so going forward, new power in the US will likely come from technology company investments as well as the expansion of clean energy. And we've already started to see that. So look at the clean energy deal between Brookfield and Microsoft. It supports the development of 10.5 gigawatts of renewable energy. And that's been compared to roughly half the solar and wind generation in the state of California. The costs are big. They're really, really big. The U.S. Energy Administration expects to build 55% more power capacity this year versus last. Most all of that is coming from clean energy. The other part of this equation is AI can actually help make energy output efficient. So you're starting to see a lot of companies and utilities that are very focused on this. So how can AI forecast inconsistencies associated with intermittency of renewable energy? So this load shifting that Google has tried out is they can shift peak consumption times to be in line with high output times. AI is also measuring outages for utilities. So I think there's a lot to be learned here. And so specifically from an investment standpoint, I mean, the winners today are clearly AI, data centers, power generation. The U.S. utilities sector is one of the top performing S&P 500 sectors this year. It's up, low teens. So in summary, economics can drive development. But until then, there is this race to find, add, and generate power, which could put stress on the current infrastructure.
It's really interesting that utility stocks are growth stocks again, and we've started to see them be represented more widely in some of our portfolios, both internally and externally. I think also a really interesting point on how the tech companies themselves can be playing a role here. First, that AI could help solve the problem of matching energy production with consumption, the right times of day, et cetera. But also, there's such financing issues with getting, solar developments done, and the fact that tech companies are building some of their own data centers and might be willing to finance the development of solar to power those data centers, that kind of gets over one of the big problems that's been had of how do you finance some of these utility scale renewable energy projects. So Eric, maybe to you, what trends are you seeing in the build out of the AI infrastructure and how are they reflected in portfolios?
Thanks, Sid. Beyond investing directly in NVIDIA, which is up another 125% this year, there have really been two primary paths to invest in the AI infrastructure theme across public equities. And the first one is Erika described, traditional value sectors like utilities, energy, industrials. They've experienced some lift from the expected increase in power consumption associated with the build out of these data centers. Among utilities, it's not really the regulated utility businesses that we've seen the stocks pop. It's in the independent power producers, such as Constellation Energy, which has doubled this year, that benefit from demand growth and anticipated demand growth in part of their business model that is leading to very, very strong stock returns. And in industrials, I would call out a company called Train Technologies, which sells heating, ventilation, air conditioning, and refrigeration systems. Carrier, another company in the HVAC space, has commented that GPUs generate roughly 7 times the amount of heat as traditional chips. Thus, Train's chillers are essential for an effective data center build out. Now, on the other side of the spectrum are other semiconductor companies that support the data center infrastructure by creating products that move, store, and process the data in an accelerated manner. So in other words, these are companies that are selling products and materials that are part of or attached to NVIDIA's massive stack designs. Some companies are also developing custom chips, which are known as ASICs. That's an acronym for application-specific integrated circuits, for large and stable workloads, such as live streaming or video on demand. Marvell Technologies navigates in both of these areas with tremendous potential growth against a much smaller revenue base relative to a company like NVIDIA. And tangential to this entire discussion, I would call out the success of digital advertisers such as Meta and Alphabet, along with smaller players like Pinterest, that have generated improving revenue growth driven by enhancements to their ad platforms thanks to generative AI. Overall, ads are experiencing improvement in relevancy driven by higher return on investment for advertisers. Meta, on its earnings call, called out that 30% of the posts on Facebook feed are delivered by its recommendation system, while 50% of content that viewers see on Instagram is now AI recommended. Collectively, these are the groups of companies that are experiencing the strongest revenue growth associated with generative AI today.
Sid, maybe we should shift to some other areas of the market. Let's talk briefly about biotech. This is an area that you've done a lot of work in recently. And overall, the space has been in a trading range and has not made it back to its 2021 levels. What's going on and what trends are you seeing?
Well, it's certainly not an area that is hyped anywhere near to the extent that AI is today. I guess we could start there, but I think we see a number of positives. The FDA last year approved 55 novel drugs. That was close to an all-time record. And really for 20 years, the FDA was approving maybe 25 or 30 novel drugs a year. The last 5 years, that has jumped to over 50 a year. So a near doubling of the pace of approvals. And some of that comes from legislation and changing incentives at the FDA to move more quickly, incentivizing focuses on rare diseases, creating a fast track for drug approvals. But there's also been a surge in innovation. And clearly the weight loss drugs, the GLP-1s get a lot of attention. That's in a way kind of using an existing drug for a new purpose. I think where we've seen some really interesting developments are in areas like oncology, cancer treatment with immunotherapies, antibody drug conjugates, cell and gene therapies, and radiopharmaceuticals. I'll try to briefly touch on a few of these. They are pretty interesting. Broadly, they're all ways to enable your own immune system to better fight cancer cells or to deliver more targeted therapies to more selectively kill cancer cells and avoid killing healthy cells. Right now, the biggest cancer drugs on the market are drugs like Keytruda that are so-called PD-1 inhibitors. They basically take the brakes off of your immune system's response to cancer cells. They've been around for about 8 to 9 years, but they're constantly being tested and approved for new forms of cancer. Then in 2022, we saw the approval of an antibody drug conjugate called Enhertu that is likely to become the most widely used ADC. And it is designed to latch on to a protein, HER2, that is overexpressed in cancer cells, and it can deliver a targeted anti-cancer drug. When they presented their data at this big cancer conference, ASCO, in 2022, they showed the drug could reduce disease progression and death by 50%. They received a standing ovation. So these are really breakthrough treatments, and that has accelerated investment and innovation in that ADC space. Radiopharmaceuticals are an emerging space that seeks to deliver radiation therapy more selectively to cancer cells. And there have been some big acquisitions in that space in the last few months, and expectations that there will be some breakthrough therapies developed there. And lastly, cell and gene therapies, they're designed to do things like re-engineer your own T cells so that they can better target cancer cells, or to literally inject designed genes into your body through a virus to help correct for some of the mutated genes that you may have that cause rare and deadly disorders. 2/3 of all cell and gene therapy approvals have come just in the last 3 years. Last year, we got the first drug approval that utilizes the CRISPR gene editing tool. This year, we just got the first approval for a T cell therapy in solid tumors. So there's much debate about the cost of these treatments, but there's certainly breakthroughs. So we've seen a really impressive pace of innovation in more targeted therapies. And I think we're seeing a transformation of the standard of care in many of these areas. So this is good news for patients. In the meantime, biotech markets have not really been seeing the love. They've been hit very hard by higher interest rates and a higher cost of capital. This is probably the one sector that's impacted most by higher rates. These companies need a lot of cash for R&D. They won't have earnings for many years, so the market has not taken kindly to them of late. So what we see is a sector that has lots of innovation, cheap valuations, and it's surrounded by large pharma companies that are flush with cash, and those companies want to buy their next leg of growth. So we've been relatively bullish, even if we size allocations here pretty small, given all the risks. I'd say, on the market side, just one quick interesting development that we've seen has been the increasing use of PIPEs, which are private investments in public equities. This is a way for biotech companies to raise cash. People give them money in exchange for locked up shares that they can't sell for some time. And some of the biggest biotech investors right now are going over the wall, which means that they can see non-public data prior to making these private investments in public companies. And the market is rewarding these deals. So share prices are often rising after these deals, regardless of how dilutive they may be. Just this month, we saw a $550 million pipe into a cancer company that we follow. It diluted shareholders by 40%, and the stocks still went up 20% on that news. That gives you some sense of how capital starved and undervalued these businesses are, and how positively these deals can be perceived. So I think we've seen more pipes in the first 4 months of this year than in the last 2 years combined. And many of the external managers that we partner with are leading these deals. So maybe, Eric, after that, dive into some of these areas. What have you seen in life sciences, tools? What are you hearing from some of our companies? And maybe if you have time, what impact will some of the changes to Medicare Advantage have on this space?
Well, Sid, I would say broadly speaking, in the public equities, we feel similarly to the way you do. It's been a really tricky sector to navigate in recent years, but valuations have come down and perhaps the worst is behind us, but I'll dive into some of the details. One of the challenges for the sector has, in fact, been the success of GLP-1s, and stocks like Lilly and Novo Nordisk have done quite well based on that. But it's been a real challenge for investors regarding the growth trajectory of numerous medical device businesses in a variety of fields. Take diabetes management or sleep apnea, for example. These are areas that GLP-1s might succeed in reducing the total addressable market down the road. And so investors have been wary of that possibility. Next, managed care providers like United Healthcare have underperformed this year. Lower government reimbursement for Medicare Advantage coverage than was expected, especially in light of the increased volume of patient visits we've seen since late last year, perhaps in a rebound post the COVID environment. Eventually, these insurers may respond by offering fewer benefits and be able to provide better margin performance based on that. But for now, it appears that profitability is constrained, at least through this year. Lastly, in recent quarters, life science tools companies like Danaher and Thermo Fisher have experienced negative earnings estimate revisions, which is really uncommon for these very high quality companies. But it's been driven by a combination of factors. Elevated customer inventory levels following COVID led to softer sales, while weaker biotech funding in the aftermath of the regional bank crisis reduced industry demand for equipment and consumables. I would say lastly that China, which accounts for close to 10% of revenue for these types of businesses, has seen a meaningful slowdown despite recent government stimulus efforts to try to turn around activity levels. So overall, it appears as though these macro factors either have or are in the process of bottoming, which is why Danaher and Thermo are up this year in an absolute sense, but they've continued to trail the index returns.
Maybe we can shift now to another theme we talked about earlier, which is aerospace and defense. So Eric, back to you. Why are these companies performing so well? What are the drivers and what are you seeing in the companies we own?
Well, I would say that the strength in the aerospace and defense space this year really is attributable to three factors. The first is Boeing. Boeing's well-known safety challenges have led to fewer deliveries of new planes, and it's also led to additional scrutiny on the existing fleet, meaning that more repair and maintenance is required. And so companies that are in the aftermarket supplier space have been clear beneficiaries of accelerated activity associated with the existing fleet. In addition, as I mentioned earlier, travel demand just remains robust across the board. We heard it from HEICO, which reported earnings yesterday, which is an aerospace aftermarket supplier. And really that whether it's by leisure or corporate travel, anywhere around the world, it's just strong, period. And that helps the utilization of the existing fleet further and requires additional servicing of those planes. So that's really on the commercial side. On the defense spending side, many companies have called out that the current uncertain geopolitical environment that we're seeing is leading to government spending more on defense. And so companies like TransDigm, which is an engineered aerospace component manufacturer for both airlines as well as the defense industry, and then GE Aerospace, which generates about 70% of its commercial engine revenue from parts and services, have seen outsized depreciation year to date. They're not the only ones, but those are just a couple of examples to provide.
I've noticed that a lot of our global and European focused managers have really leaned into this space a lot over the past year, and it's been additive to their performance.
Definitely have. And I would say industrials has become a pretty significant overweight from a sector perspective for a lot of our external managers, and it's really aerospace. And luckily, I think we've been on the right side of the Boeing Airbus situation. So we have people who own Airbus, but also the engine manufacturers, and we've had good exposure to GE and Safran and all of those dynamics that you just outlined there. And these are great businesses that tend to go in cycles based on deliveries, which are then followed by very high margin servicing of the planes, of the engines. So they're incredibly profitable businesses, particularly at certain parts in the cycle. And I think we have a lot of people who are very experienced in covering these companies and picking their spots when to be larger in these companies based on where they are in those cycles. So I think the dynamics are still very positive for air travel company and individual alike right now. And as you say, it's a little bit of a supply constrained market because of all of Boeing's issues. So I still see it as a pretty big overweight for a lot of our managers. Maybe, Eric, before we go around the horn and just talk about things that we're looking at, on a completely different note, you just wrote an interesting piece on falling fertility rates around the world and investment implications. Can we just spend a minute and have you share what some of the high-level takeaways are there?
Yeah, so this goes from looking at earnings on a day-to-day basis to thinking about a topic that is probably going to be in discussion for decades to come. But I found it interesting that in both the Wall Street Journal and the Financial Times in the last week or so, there have been long think pieces on the same general demographic topic. And it's that for the first time in human history, Global fertility rates, which are defined as the number of live births per woman aged 15 through 49, are close to dropping below what is considered the replacement rate. So, in other words, should this trend persist, the human population is likely to move into decline by around 2060. So, compare that to just a few years ago, the United Nations published a study suggesting that the world's population would continue to grow well into the next century and perhaps into the 2050 range. So something really material appears to have changed over just a short time span. What history has shown is that it's very difficult, even with government intervention in a variety of policies that are supportive, to see fertility rates rise once they've been in steep decline, like we've seen. There are many fascinating reasons why this trend could be accelerating that we could talk about for the next several hours that we won't, but it's just important to recognize that Europe is already experiencing a falling working age population. Perhaps advancements in productivity and efficiency from innovations like generative AI, since we've talked about that topic so much today, will more than offset the demographic challenges that we're seeing all around the world. However, themes like immigration policy, social programs, and taxation are likely to be hot button topics in the decades to come. It's probably well beyond my own time horizon, but nonetheless, something for us to perhaps ponder.
I think about it in a few ways. I mean, it's really hard to think about when the whole world will have a shrinking population. But if you look at the microcosm of Japan, where population has been stagnant, declining for a while, the implications there were generally slower growth and deflation. I know we talk so much about the inflationary picture here, but I think there are some interesting long-term deflationary forces. Demographics are one of them. AI and productivity could be others that could be a counterbalance to this overwhelming inflation narrative, I think, that we deal with today. So maybe let's do that round the horn and talk about actions we're taking in portfolios. Maybe, Eric, kick it to you and then move to Erika.
Thanks again, Sid and Erika, for having me this time around. Our strategies overall have been fairly active this year. It's a function of a highly productive analyst team combined with this very narrow market leadership that we've seen and pretty volatile stock reactions to near-term data points, like I mentioned with Salesforce earlier today, as a microcosm of what we've seen in the market in response to earnings. Investors tend to extrapolate the latest data point, often related to a change in the rate of growth, and assume those trends will continue indefinitely. As we've talked about today, the market is highly thematically driven right now, leaving, in our opinion, high-quality businesses in out-of-favor sectors or subsectors within its wake. And based on that, we've been finding opportunities across healthcare, enterprise software, and even insurance, where we think a multi-year time horizon will be rewarded with strong price appreciation.
Erika, what about you?
Yeah, I mean, taking what Eric just said and repeating that this is a mixed market environment, one that probably needs rates to move lower to really start to see more broadening, sustainable returns. We're in this bull market, but not everything is participating. So we're not making very large shifts in client portfolios. We're fairly neutral. We've been underweight core fixed income, utilizing treasuries, extending duration to lock in yield. We're very mindful of the short end of the curve and how that can change very quickly once the Fed changes its posture. Maintaining high yield as a surrogate for credit despite tight spreads, adding to securitize, adding private credit where it makes sense. And across most all portfolios, we've been rebalancing. And by rebalancing, trimming some of the U.S. large cap growth areas that have done so well, making sure we've got a good balance between growth and value within our equities. And we remain underweight emerging markets and have been adding more to strategies that are higher quality, more flexible, and global. Sid, what about you?
Well, I would like to underscore the points that you guys made, both of you, about the narrowness of the market and that leading to opportunities outside of the mega cap winners. We do have plenty of exposure to Microsoft and Alphabet and NVIDIA and what have you. But what we're seeing from our external managers and our internal teams is we're seeing some trims in some of the companies that have performed exceptionally well and moving to some of those unloved areas of the market for sure. And that's something that just happens kind of under the hood where we're not making changes as a portfolio manager on a balanced portfolio. It's happening within the strategies. So that doesn't require us to make individual changes. As to those kind of asset allocation shifts, I talked already about biotech, which is a piece of portfolios and haven't added much to it, but constantly thinking about kind of rebalancing to keep it at the right size. Also adding to core fixed income as yields kind of approach 5%, which I think is a good area of value. We talked a lot about Japan and have been adding some exposure to Japan despite those demographics we just talked about. We have the dynamics of cheap valuation, improving corporate governance and profitability, and really a lack of correlation with what's going on in other areas of our portfolio because of, the unique transition that I think that economy and that market is going through. Trying to stay disciplined and recommitting to our highest conviction private equity managers, despite the fact that it still feels like there's a bit of a stalemate in those markets with transaction volumes down a lot. I think it's important to take a time like this and continue to give money to our best private equity managers. And also we found some interesting one-off deals sourced in areas like data center developments, which we just talked a lot about. The last area of focus for me has been in tax-advantaged equity strategies for taxable clients, especially portfolios that have a large allocation to hedge funds or less tax-efficient active strategy. If we can balance those investments with tax loss harvesting strategies to generate some offsetting tax losses, that's a good thing. And it's become a bigger part of portfolios that I manage. And that also includes some innovative approaches that add short exposure to these strategies to generate even more losses. So plenty of things going on, but I think, as you guys both pointed out, some of these company by company decisions that are being made under the hood of the portfolios that we have long-term allocations to are a really big piece of the story. So with that, thank you all for joining us. Thank you, Eric, for coming on the pod today. And we look forward to getting feedback from you and hope you join us next time.